So cost segregation enabled you to take it on a 5 and 15-year cycle. In 2017, Trump introduced that you're able to take bonus depreciation, which allows you to take all 5 and 15-year property on year one. So if 5 and 15-year property makes up 20% of your purchase price, which a lot of times it does, you can get back on $1 million purchase almost $200,000.
Welcome back, everyone, to the Passive Road to Retirement podcast. I'm your host, Andrew Jarrett. Today, we're joined by Isaac Weinberger. Isaac is a cost segregation expert working for Madison Specs, a national cost segregation firm. He has helped real estate professionals offset millions in tax liabilities. He also hosts Tuesday Connections, which is a weekly Zoom meeting with special guests and a great group of investors who attend. Isaac, welcome to the show.
Thank you so much, Andrew, for hosting me. I appreciate this. It's a great opportunity, and I can't wait to let everybody know all the nuances of cost segregation and how it can help you.
Absolutely. Yeah, we're glad to have you on. So I guess maybe you could give us a little background on how you got into cost segregation.
Absolutely. So it's interesting. I actually was managing a clothing line before I came into Madison Specs. And then a lot of friends kept telling me, Isaac, you've got to get into the real estate world. And I wasn't sure exactly which space I wanted to pivot into. I met with many people, many successful people. And a lot of them told me, hey, Isaac, maybe down the line, you'll start syndicating or doing those types of things. But right now, you'll be great in sales. I met with a couple of people. I wasn't sure exactly what I wanted to do. The topic of cost segregation came up, and I was taken by it. I believe that you have to be passionate about what you're selling. And I love the idea. I came in. It gives me the opportunity to meet many real estate people, from syndicators, operators, LPs, all types of nursing home operators. So it's really everybody, and unbelievable. That's how I'm here.
Absolutely. Well, you're definitely a connector. I know you've connected me with people before in the past, and you have a great Rolodex. That's for sure. So, what kind of? I didn't know you were in clothing sales before. What'd you do?
I was managing a clothing company, coming up with new ideas, marketing, some actual designs, which was pretty cool. But it was really long hours, and the potential over there, even though I could have made a decent salary, was really capped out. So for two reasons, I wanted to come into real estate. First of all, the potential money-wise, but on top of that, it's just the passion that I've always had, and I feel like I was missing something.
Absolutely. Great. I agree. I love real estate. I've been doing this forever, so can't complain. Now, maybe you could explain how cost segregation works, and maybe who it would benefit.
Absolutely. So it's interesting. Before 2017, cost segregation was in effect, and people did do cost segregation, but it wasn't as productive as it is now. And what changed from 2017 and on is like this. Before 2017, anytime you own a property, commercial or residential, you get depreciation, which means anytime you own a property, you can get back almost your entire purchase price and tax write-offs. But there really are components of the property that technically are allowed to be taken at a faster cycle. But a regular accountant is not aware. He's aware, but he's not an engineer, so he can't actually go in and segregate those components. So he throws all three components of structure, land improvement, and 5-year property, which is the tangibles, under the same exact category of 27.5 or 39-year depreciation. So technically, you're able to get your depreciation on a faster cycle, and you're not getting it. So cost segregation enabled you to take it on a 5 and 15-year cycle. In 2017, Trump introduced that you're able to take bonus depreciation, which allows you to take all 5 and 15-year property on year one. So if 5 and 15-year property makes up 20% of your purchase price, which a lot of times it does, you can get back on $1 million purchase almost $200,000. The way I put it, I'll just say one more thing over here. The way I put it out to my clients is, if I owed you $100, Andrew, what would you rather? Would you rather that $100 over 10 years, $10 a year, or would you rather $100 in year one? I think everybody.
Yeah.
Exactly. So the idea is just front-loaded depreciation, taking on a faster cycle.
Yep.
And
how does somebody come out? Like an engineer comes out from your company, right? And I guess how does that work?
Yeah. So great question. a lot of people ask me, why can't we just guess and just assume that we could take X, Y, and Z and we could take this percentage? What we do is the engineer comes down to the property and he actually segs out every last light bulb. So if he sees carpet, flooring, light bulbs, door handles, whatever it could be, that could be taken at a faster cycle, as opposed to if you just go ahead and pick a number, you could be missing out on many percentage points of what technically you could get at an earlier stage. So we send out engineers to the property, they segregate it, we document it into a 90-page report. It sounds a bit big, but it's very, very precise, and it's a smooth process. We actually have feedback from accountants that said, hey, everything just works in sync. We send it over to your CPA. He fixes it up according to your tax return, and then that's it. And everybody on the, let's say you syndicate a deal, all the investors on their K1s will get back proportionately their portion of depreciation. So that's amazing.
Yeah. So GP and LP both get the appreciation. Mm-hmm.
Yeah, and I'll just stick in something interesting, Andrew, is that I've seen over the years when GPs go to investors, syndicators go to investors and say, hey, do you want to invest in my deal? A lot of times the investors want to know, hey, I want to know how much I'm going to get back in depreciation. Mm-hmm. It does change the dynamic. Multiple times I've seen this.
Oh, yeah. It can really escalate your returns if you're getting that kind of depreciation back. Mm-hmm.
Yeah.
Yeah.
So it's
interesting. Now, is there a certain property type that you think would benefit from this more? Is there a certain value or size?
So that's also a great question. Many people have the misconception that multifamily is the only property that cost seg benefits. Mm-hmm. I want to tell the audience something astounding. I'm going to go through the couple asset classes of how much percent you should expect. Single family houses, I would say you should expect anywhere from 15 to 20% of your purchase price in year one. Weir houses, I would say you can expect anywhere from 10 to 15, 16%. If the parking lot's a bit bigger, it could be a little bit more. Office and retail, same idea, I would say around 15 to 17%. Multifamily could be anywhere from 17 to 26%. Wow. So multifamily is incredible, mm-hmm. But you got to wait for this, everybody. Mobile home parks could get anywhere from 30 to 65% of your purchase price in year one. There is a lot of 5 and 15-year property in mobile home parks.
Wow.
But there's the last asset class, which many investors and many real estate professionals do not know about, is car washes. Car washes can get you close to 90% on year one. So if you're getting hit with a major tax bill and you don't want to do multiple cost segs, you could buy a car wash and take close to 90% of your purchase price in year one. So Just to make things clear, cost segregation is worth it to at least reach out to a cost segregation expert and find out how much will I benefit, because almost every single asset class is applicable.
Mm-hmm. That's incredible. I did not know it's 90% on a car wash. Wow.
It's really great.
I guess what would be the cost of doing these studies? Is there maybe a minimum purchase price somebody would want to consider, to get the values?
Yeah. So these are all great points, Andrew, because a lot of times people say, oh, it's too small of a purchase price, so it's not worth it. I say anything 400,000 and above is worth it. There are certain situations, if somebody has, let's say, 10 single family houses that he purchased for $200,000 a door, that we will do like a systematic study, and we'll be able to do 3-4 studies on all 10 houses and get it to him for $2,000 or $2,500 a property. There are certain cases we do that, but usually I say generally it's 400,000 and above. But we do deals ranging from $400,000 houses to $200-300 million properties. Mm-hmm. I actually just had the honor to do a big time deal, a couple $100 million properties. So it's amazing. I get to speak from the small people to the big people, everybody in between. Mm-hmm. It's unreal.
That's awesome. That's awesome. Now, speaking of, maybe you could give us some examples of deals you've seen where, the amount of money people have saved and kind of how that was structured.
Yeah, so I appreciate that. Somebody reached out to me last week and he said, hey, Isaac, I want to do a cost seg study on my property that I'm about to go under contract. So I said, his name was Ari. I was like, hey, Ari, I'd love to do the cost seg for you, but you just told me 2 months ago when I called you up, you don't want to do cost seg because you might be selling it. It's not part of your strategy for whatever it is, whatever reasons he had. He said, I have an investor who wants to put $500,000 into the deal. And he told me, Ari, I'm not going into the deal unless you do cost seg. And the reason being is because if he's putting $500,000 into the deal, and let's say he has a 25% stake in the property, he's going to get back X amount of dollars in depreciation. So it's only worth it for him to do that in order to get that back. I've been on many meetups where people have been talking about cost segregation. And one person specifically was talking about how the investors didn't get back what they were promised. And they said that they're not going to go into a deal in the future with this syndicator because the only reason why they went into the deal was to get back their depreciation. So sometimes people don't think there's such a big stress put on that depreciation, but there really is.
Yeah. Mm-hmm. Yeah, especially for real estate professionals, because you can write that off, completely.
Sure.
Now, are you familiar? I know, you're not CPA or tax advice, but how does it work for somebody that has a W-2 job and they invest in something like that?
It's a great question. I actually got off the phone a half hour ago with a relative of mine who is a big CPA in upstate New York. And the reason why I called him is prior to that, I was on the phone with a client who purchases 4 to 5 properties a year of north of $5 million. And she told me that she can't do cost segregation because she's on W-2 income. So I'm trying to work out for her to file as a real estate professional. Now, even if somebody's on W-2 income, it's not a lost case. It's possible to still file as a real estate professional if you are spending 750 hours or more in real estate a year. Mm-hmm. So if you are spending, and accountants have to know this because accountants automatically, if their client is on W-2 income, most of the time will not file their client as a real estate professional.
Right.
And their client could technically be gaining hundreds of thousands of dollars in liquid cash of not having to pay the IRS if they would do cost segregation. Mm-hmm. So people have to know it's not simply put that if you're on W-2, you cannot file as a real estate professional. It's definitely worth it to speak to a CPA, speak to other CPAs, and find out more because It's a shame not to get the depreciation that you're deserving of.
No, I totally agree. Totally agree. Now, would you say there's a minimum hold period somebody wants to hold the property if they're going to do this, or?
So this is another great point. I just want to say I've been on many podcasts, and Andrew, you're really nailing the great points over here for the audience, and it's amazing. Okay. Recapture is an extremely important note, extremely important point to note, because I tell clients all the time, if you're going to sell the property after a year or two, it's not worth it because you're just going to get hit in the face with that big tax bill again, and you're paying for a study for just a year of having deferred income. Sometimes it's worth it on a very big purchase, but many times it's not. Mm-hmm. I generally tell prospects and clients, if you're going to hold on to the property for 3+ years, that it makes it very well worth it as it's an interest-free loan, time value money. But there's another added component over here that people have to know. If you're going to 1031 exchange your property, so if you're going to buy property, do a cost seg, and you're like, hey, maybe I shouldn't do a cost seg because I'm going to get hit with recapture. If you're going to 1031 it, you do not have to pay back recapture. So somebody whose strategy in real estate is 1031 in the properties all the time, you have nothing to worry about.
Yep. Wow, that's great. Yeah. You can really offset your taxes on that strategy.
Absolutely. Absolutely.
Incredible. So there's a lot going on in real estate now. I'm sure you're seeing a lot of deals coming through. You're probably looking at a lot of cost segs. What's most exciting to you right now in the cost segregation world?
So I'll tell you like this. What's so exciting about my job is, like I said before, I get to speak to people that are purchasing 3-4 single family homes, to people that are purchasing $300-400 million deals. And somebody like I, who plans down the road to start syndicating some deals myself, to be able to meet all these people in the space and to learn and educate myself, because every single situation is different, and to learn different components of the game is tremendous. So I love learning about multifamily, industrial. A lot of people that are syndicators, they focus on multifamily, and that's what they know. But because I'm speaking to people that own industrial, office buildings, retail, I get to meet people all over the space. For example, I'm going to the ICSC in Vegas later this month, and that's a retail and development conference. So I really get to meet people from like I said, all different points in the space of real estate, which is very exciting. Mm-hmm. That's really what it is. I'm definitely scared with what's going on with interest rates, that people are going to slow down on buying, but let's see what happens.
Yeah, I agree. I mean, Fed just raised it, 50 basis points yesterday, but there is a definitely lack of supply out there.
So definitely a lack of supply. Definitely a lack of supply.
Now, speaking of, I mean, like I always say, your network is your net worth. So you're definitely building up a great network, and I'm sure you'll, reap the fruits of that down the road. Absolutely.
No, yeah, for sure. And that's something that I put a big stress on, that meeting new people on LinkedIn and going to conferences and hosting my meetup and giving back to my clients. It's the most important, not just taking their business, but trying to set them up with investors, with deals, equity partners, whatever it could be.
Mm-hmm. Now, speaking of your Tuesday connections, how does somebody find that? How do they sign up to be on that Zoom, and what can they expect to see and learn?
Absolutely. So I'm very active on LinkedIn every single Tuesday morning, a couple hours before I post all about it. So connect with me on LinkedIn, Isaac Weinberger. It's a great meetup. I'll tell you a couple points about it that I really love. There's a lot of great meetups out there that I love and I enjoy going to as well. I try to keep it short to 35, 40 minutes. Sometimes the longer meetups get a drop too long, in my opinion. Yeah. We have a speaker for like 10 to 15 minutes every time. Every week it's a different speaker. Sometimes it's syndicators, sometimes it's brokers, but very successful people do come on to the show to speak. And then we ask them questions afterwards. And we network and we talk to each other. Last week, for example, we tried something else. We did breakout rooms and everybody enjoyed it very much. So I think I'm going to be changing the dynamic a little bit to get a speaker for a few minutes and then the last 20, 30 minutes do breakout rooms. But I'll tell you like this, there were 3 deals already closed just from my meetup. And I'm not talking about cost seg deals. I'm talking about people co-GPing and people going ahead and finding deals through my meetup. So we have 15, 20 guests that come on, attendees every single week. It's probably my highlight of the week, and yeah, I'm excited for this Tuesday.
That's awesome. I'm going to have to join.
Yes. We have to have you as a speaker.
Yeah, absolutely. So. Now I know you've been in the industry here, and I know you've done. We spoke prior. You've done a few passive investments, and this is the passive road to retirement. So, how has your experience been, passive income wise? Do you think it could be life changing for you? Seeing the passive income just hit your account every month, and what are your thoughts on that?
Absolutely. So I would say, actually, from a passive income perspective, the first investment that I put money into, I actually lost everything. I had a friend that was starting a fund investing in real estate, and he was offering big numbers. I didn't really know what I was doing. He told me I'll get back X amount of dollars, and he actually lost many, many people's money. And that was a big lesson for me, just to be much more careful about it. So I went in on another deal, actually in Philly, and I'm able to go ahead and make some money on my principal every single month, which is amazing. It's not money that's going to alter my life. It's not enough money to do that, but it's definitely a nice bonus every single month. But eventually, I'm hoping when I do start syndicating deals a couple years down the line, I'll just take it out and throw it into with all my heart into that deal.
Sure.
So we'll see what happens there.
Absolutely. Now, if you don't mind sharing, maybe on that deal there, what maybe 1 or 2 things that you've learned to look for in the future, based off that experience.
Absolutely. So I personally think syndicators and operators that offer crazy numbers right then and there is a red flag. That doesn't mean you shouldn't go with them. Obviously, do your due diligence and look into them. Maybe they have a specific structure of the deal that's going to allow them to give back those numbers. But that itself has to be a red flag. He was very young. He didn't have any deals under his belt. I believe you have to go with somebody just like you that's done multiple deals in the past. They know what they're doing. They have sponsors that endorse them. They're not just a random Joe off the street that just, hey, put together something. Obviously, you should run it by a couple people. I didn't run this by anybody. I just did it without thinking. Run it by a couple of serious people who know what they're talking about. Just say, hey, does this make sense? Does this look right? But to be honest, I'm not happy I lost that money, but it was a very big lesson for me in life just to take a back seat and not be impulsive.
Yes.
So I definitely was able to, it was an expensive lesson to buy, but it was a great lesson that I got out of it.
Yep. Yeah, I had something similar happen to me in my early 20s, and I'm glad it happened in my early 20s, rather than later in life. And it's definitely the losses of money that teach you the most, I think. You don't forget those.
100%. 100%.
Now, do you have any daily habits that you do that, help you, become successful? Meditation, working out, anything like that?
Oh, so yeah, that's a great question. It's very interesting that you ask. Some people, I don't think we're born hustlers. I think that some people just have a crazy work ethic. Mm-hmm. It's interesting. When I was much younger, 11, 12 years old, I used to mow lawns. We used to make a lot of money. Me and my brother, we started a whole business.
That's awesome.
Then when I was in school, I used to give many haircuts to all my friends. I used to make a lot of money that way. Nice. I used to tutor kids. I always had that hustler mentality of a go-getter mentality in me. Mm-hmm. So when I wake up in the morning, obviously I have to focus and realize the most important thing in life is my family and becoming a better person. I can't get too wrapped up in the business world and let me take that over. We don't live to work. We work to live. So therefore, I want to enjoy my family. In the beginning, when I started, I was very, very busy with my phone and business. But now, obviously, work is very important and clients are very important. But there's family time, there's work time. I love to play basketball. I love to hang out with my friends, make some barbecues on Sundays. So you definitely have to have that right balance. But life is great. We have to keep the focus.
Exactly. Can't take it with you, right?
Yeah, exactly.
Balance it out. Now, if you could have the audience with one takeaway from this episode, what would you want them to absorb from this?
So what I would say is, first of all, on a practical level through Cost Seg, what I would say is if you own any investment property or you're an LP in a deal, find out if your syndicator did Cost Seg. Find out if it's worth it to do Cost Seg. It's not going to hurt. It's a phone call away, either me or somebody else. It's usually free for a complimentary proposal. That's in terms of real estate. But also, like I said before, in terms of everything else, it's really important we didn't talk about this so much, but what I saw that my success really came from is honesty and authenticity, is really going ahead and being there for my clients, trying to help them out without getting paid for it. I spend hours on the phone with clients, being there for them, helping them with management companies, investors, different deals that I'm not getting paid for. Mm-hmm. But the idea is the more you give, the more you give, the more you get. There's nothing to talk about. Being authentic, being honest, but staying true to yourself.
Yep.
There's going to be rejection sometimes, but you know what you're worth and just keep going.
Love it. That's great advice. Which brings me to my last question, then we'll get into our 5 to Thrive section. So if you could step in my shoes for the interview, is there anything you would ask yourself that I didn't ask you?
I like that question.
Yeah.
I like that question.
Thank you.
So technically, what I would have asked was, Isaac, what makes you different? What makes your company special more than other cost seg firms? But I definitely did rave about myself a little bit about the fact that I'm there for my clients. But just to point out again is that I don't ever bash any other companies. I don't put down other companies. I think that's the wrong way. I think there's great companies out there. There's great cost seg companies out there. But what I will tell you is that Madison Specs, and me specifically, I know this about myself, that we will go above and beyond for a client. We don't view a client as a customer. We view a client as a relationship. We host a big conference in Florida every year. We invite our clients there to meet other investors, other like-minded investors. We all the time, I've seen it from colleagues of mine, going out of the way and delivering gifts to clients just out of the blue, just to show, hey, we didn't forget about you. Mm-hmm. And to be honest, I had a client that actually was supposed to come to me for business, and he ended up, it was in a pretty rude way, he left. And obviously I was a little hurt about it, but I decided, you know what? First of all, everything's from God, but on top of that, you never know. If I just get upset at him, he'll never come back. I went down to him. I spoke to him. I bought him a bottle of wine. And And he said, you know what, Isaac, this is really special. He said, let's talk again on the next property. And I could have got upset, but instead I went over it and dealt with it in a mature way. And now I'll make more business.
Yeah, exactly. That's awesome.
So,
good lesson. Yeah, exactly. Now, how can people reach out to you and get in contact with you? What's the best way?
So absolutely. The platform that I'm the most active on is on LinkedIn. So Isaac Weinberger, send me a connection request. I definitely will accept it. If you DM me on LinkedIn, my info is on my LinkedIn profile. I think my number and my email address. I'd love to talk to anybody about cost seg or just real estate in general, or if you just like to say hi.
Yep.
And I'll definitely walk you through the process.
Awesome. Sounds good. So now we get to our 5 to thrive. So this is basically just a word association game. So I'm just going to rattle off 5 words, right in order, and just give me the first word or phrase that pops into your head. The only caveat is you cannot repeat the same answer.
Okay.
Here we go. This is a fun section. People usually like this. So the first one is depreciation.
So I'm supposed to go ahead, just remind me, I'm supposed to go ahead and say a word for it?
Yeah, whatever pops into your head first thing when you think of depreciation.
Cost segregation.
Tax deduction.
Properties.
Yeah.
What tax deduction?
Real estate.
Multifamily.
Passive income.
I'm not good on the spot. Passive income.
Multifamily would be the answer, but you can't reuse it, right?
You want me to use business terms or like funny terms?
Oh, anything that comes in your head.
Passive income brings me to think about vacation, because I could go ahead and enjoy now.
Exactly. That's right, man. That's what it's about. And last one is Madison Specs.
Integrity and honesty and client relationships.
I like it.
You put me on the spot, Jarrett.
I know, right?
Andrew, right.
Well, Isaac, man, it's been a pleasure having you on. Thanks so much for being here, and great value in this episode.
This was amazing. I really, really appreciate this. This was awesome.
Great.
Thank you so much.